In this video, we will look at the main reasons behind the recent drop in price for Warner Bros. Discovery. We will look at their earnings call of 2022 first quarter earnings call. Most importantly, we will look at what management is saying about the earnings and what are their projections and expectations. We will also adjust our fair value calculation accordingly. So let's get started. First of all, if you are not subscribed to the channel, you can do this by pressing the subscribe button under the video. You will not miss a single new video. Okay, Warner Bros. Discovery is down more than 30% from year to date. What are the main reasons behind the drop? First of all, of course, is the negative market sentiment. S&P is down close to 20% from year to date. So it's almost in the bear territory. So overall market sentiment is definitely negative. The second reason is the poor performance of Netflix. So Netflix is down from 700 to 200. This is mostly due to slower growth rate. And the third reason is the poor financial results of Warner Media. The merger completion was in April, so for the first quarter, the financial results are reported by AT&T. If we look at their operating income, we can see that it is 1.3 billion, so it is down from 2 billion to 1.3 billion. So I believe the poor financial results is the third main reason behind the recent drop. So for me, it was really interesting to see the management reaction. Are their projections have changed? So if we look at the earnings call of the recent quarter, we can see that HBO Max added 3 million subscribers, while Discovery added 2 million. So overall, we can see more than 100 million subscribers for Warner Bros. Discovery. But management is also saying about the poor performance of Warner Media. So the operating income is down 33% from the previous year. So from 2 billion to 1.3 billion. First of all, if we return back to the table, we can see that operation expenses are much higher than the previous quarter. So this decline in operation income was under AT&T's management. So the situation is very likely to change under the new management. Secondly, the negative financial performance of Warner Media was offset by the better-than-expected performance of Discovery Communications. So while management is expecting for the profit for Warner Media to be 500 million less, overall it will stay the same because of the better-than-expected performance of Discovery Communications. So this brings us to the third point, that management has confirmed the financial targets that were previously. So the targets have not changed. So they have not adjusted their projections. The management is also pointing out that there will be 3 billion cost synergies. So after combining both companies, they will be much more efficient. As a result, there will be 3 billion cost synergies. So there will be up to 3 billion more profit. They have also confirmed the debt level or the leverage from 2.5x to 3x of the EBITDA. So we will use these numbers in our calculations. Okay, so this brings us to the fair value calculation. We will use the previous projections, but we will slightly adjust them according to what management is saying. So for the EBITDA of 2023, EBITDA stands for earnings before interest and tax, depreciation, amortization. We will use not 14 billion as management previously projected, but 13.5 billion for our basic conservative scenario. We are using the leverage of 2.75, which is in the middle of the range of 2.5 to 3x of the EBITDA. Free cash flow conversion of 60%. In our calculation, we are assuming the EV to EBITDA multiple of 10, which is on the conservative side. Netflix and Disney are trading at much higher multiples. If we multiply the EBITDA to EV to EBITDA multiple, we get the enterprise value of 135. We can get the total debt if we multiply the leverage by the EBITDA. We get the debt of 37 billion. We get the cash of 4.2 billion from recent balance sheet, which gives us the projected market cap of 102 billion. If we divide that by the number of shares outstanding, we get the fair value of Warner Bros. Discovery in the basic scenario, in the basic conservative scenario, of $42 per share, which implies from current price of close to $70, around 150% upside. We can also see that the current market cap at the moment of running the video is 41 billion, which implies that the free cash flow yield is close to 20%. So Warner Bros. Discovery is a cash flow generating machine. We get 20% free cash flow yield. So in the basic conservative scenario, we get the 150% upside and around 20% free cash flow yield. Okay, now let's look at the best case scenario. If we use the EBITDA of 14, we also add half of the cost synergies of 3 billion. So we add 1.5 billion, we get 15.5 billion of the EBITDA in 2023. We also use the enterprise value to EBITDA of 15, which is closer to where Disney and Netflix are trading. In this case, we get the fair value of $82 per share. We get the free cash flow yield of more than 22%. So this is the best case scenario. I believe this is on the high end. So we get from $42 to $82 per share. So I believe the fair value is somewhere in between. So from $42 to $82. If we consider that currently Warner Bros. Discovery is trading around $17 per share, this implies a huge upside potential. And that is only in 1 or 2 years, not in 5 or 10 years. So overall, I believe at this price level of $17, Warner Bros. Discovery offers a huge upside potential. The projections were the same when the price was $30, and now management is still confirming the previous projections and the price is $17. Also, management of Warner Bros. Discovery is buying the shares. Here is the video. If you are not subscribed to the channel, you can do this by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching till the end and see you in the next video.